The June jobs report saw a build of 287,000 jobs. 110,000 better than expected. So we've got, well, Christmas in July right now. The markets have erased all their losses they incurred after the UK vote to leave the European Union. Remember that 900-point two-day drop? Gone. But what's lurking for investors as we head into earnings season? Joining us along with Charlie is Janney Montgomery Scott Chief Investment Strategist Mark Luschini and Moody's Chief Economist John Lonski. John, do you believe this number? It is certainly a good one, a great snapback from an ugly May. Is it more of the same for the future? Because we just had Tom Perez, the Labor Secretary, say the July jobs report might not be as good as this one, but it won't be as bad as May.
He's exactly right. I think the June jobs report overstated fundamentals, just as the May report understated fundamentals. Average of two, and we're looking at 150,000 new jobs per month indefinitely.
Are you okay with that number? It doesn't sustain a more than 2.5%
Yes, I am. I think that's pretty good. I think the market likes that. You know, that particular number is not strong enough to bring a rate hike into play. As a matter of fact, Fed funds futures doesn't see a rate hike through June of 2017. Well,
starting next week, Mark, we start to get some earnings reports out. Now, people can underpromise and then overdeliver, or the opposite. What are you expecting here? And do we see a market during the slower days of summer grind higher or drop?
Well, first of all, on the earnings front, Liz, I expect we're going to see the usual MO, which is the fact that companies have sufficiently lowered the bar such that the beat ratio will come in about 3 out of every 4 companies outperforming what they had set the market up to expect for their earnings. That said, earnings expectations are for earnings on a year-over-year basis to be down about 5.3%. That's a lot, and that would be the 5th consecutive quarter of declining earnings, which is exceedingly unusual outside of a recession. So, you know, a lot of pressure is going to be on the back end of this year relative to earnings. That said, as it relates to stock prices, I still think we see more of the same, which is the TINA principle being invoked. There is no alternative. Today is a classic example where bond yields continue to go lower. The Treasury is drifting lower on a risk-off day, and or a risk-on day, that is. And so you see utilities and all these other bond surrogate sectors performing well, along with the cyclical sectors.
By the way, we have a very, very low 30-year yield at 2.11%. So that could, I mean, we're almost at an all-time low. Folks, I just want to point out, we are, at this moment, literally just tiny fractions below the all-time record close for the S&P. That record close is 2130.82. We're at 2130.18, Charlie.
Amazing. And, you know, I will say this, Liz. I hate to keep bringing us back to politics, but there is a political element here. This is good for Hillary Clinton. John could talk about it, and your guest could talk about this a little more. If the economy is going to grow slowly but ploddingly forward, the real question is, do the American people really roll the dice on Donald Trump? And I'm for his economic policies, but I am just saying, as a predictive measure, generally a growing economy, even if it's this crummy growth that we're getting now, it's good for the incumbent party.
John Lonski, I'm sure you've read multitudes of history books, and as they look at the markets, et cetera, when do voters make a change, especially considering we might be seeing a better number here and there?
Well, Liz, we're getting jobs growth, but it's not of the highest quality. Throughout this recovery, jobs growth has been geared towards these lower-paying jobs. Higher-paying jobs have been left behind. Thus, we still have a low labor force participation rate. Charlie's talking about 2% growth. That sounds decent. But if the economy continues to grow at just 2% annually, that tells me that jobs growth is going to come in even under 150,000 new jobs per month. I think there's a lot of dissatisfaction out there, though we're growing, and that could influence the election.
And knowing that, Mark Luschini, what do you buy here? I mean, the financials are looking very strong because there is the belief that we might see a tiny rate hike, at least one, the rest of the year, although I'm not betting on that.
Yeah, I still think you see what's working now continue to work, Liz, and that is the fact that you have these bond surrogates, these sectors like REITs, like telecom, like healthcare, that continue to do well because, again, the thirst for yield is unquenched. And in addition to that, these companies can offer some capital growth over and above what you're likely to get in the bond market.
Great to see all of you. Mark Luschini, John Lonski,
Thanks,
Charlie
Liz.
Gasparino.